Welcome to the Daily Update. This is Being Prepared Monday, March 28th, where we'll look at the action in the market today and then see how things look for Tuesday, March 29th. And it was another positive day. Stocks started out kind of on the rough side, and it looked like we were going to have a down day. Well, as the day went on, some news or sentiment trickled through the market, and that produced some buying interest, and we were able to go from a negative stance over into a positive stance, and then we saw extended buying as the day went on. So this helps to improve our overall technical picture, but we had pretty much a flat open, and then we saw initial selling down to around the 45.20 level. Then as the day went on, prices were able to rebound and actually get back above the unchanged level, and they rebounded all the way up to R1. Going into the close, we saw continued buying. In fact, we went all the way up to R2. We ended up closing at the high, and we were up 0.71% for the day. So this bounce from that base that we appear to have come up out of so far seems to be in order and seems to be legitimate. It doesn't necessarily mean we're going to go straight up from here. We'll see some bumps along the way, or if things start entering the market that turn the sentiment a little bit more negative, we could start to see a decline, and I'll address that as I usually do at the very end of the video. We did see below average volume, and last week we saw it declining with each successive day from Monday through Friday. Monday's volume was also below average, but it was just a little bit higher than Friday, but not much. So that still suggests that there's a lot of indecisiveness right now. People don't really know, can I go long? Should I go short? Well, the market's going up, so maybe I shouldn't go short. If I go long, well, there's all these negative things going on right now. And so you have a lot of traders and investors out there who are just kind of sitting on the sidelines, waiting to see what's going to happen. As far as our technicals, they're looking much better. We're still showing some overbought extreme positive readings on some of our indicators, but a lot of them are showing some improvement. We're getting right up near the end of earnings season, and we're still dealing with inflation. That seems to be a way of life now. And then with interest rates. And I did some research over the weekend about the yield curve, and we're hearing a lot of different information out there. And instead of trying to make a stance on it, what I usually do with these things is I say, okay, this is what one person says. All right. I don't choose to agree or disagree with that, but I'm going to take what they're looking at and then look at it every day and decide for myself. And then I read or hear about something where another person's looking in a different direction. Okay. Then I'll take that, add it to my overall information, and then make my own decisions based on it that way. And if I don't go too long, I'm trying to keep an eye on how long this video is. If it doesn't end up being too long, I may break off into what I found. There's also a chance that I may make what I've found up to this point into a separate video. So as of right now, I don't know what's going to happen with all of that. We have a lot of geopolitical concerns as usual, and there were some things that happened over the weekend that have caused a little bit of uncertainty with things. And then a lot of what you're hearing about in the financial news has to do with the inverted yield curve. And that's what I'm going to address either at the end of this video or in a separate video. So what can we say about Monday? We're still out of correction territory. Every time we advance, we're getting closer and closer to getting back to that all-time high. Are we ever going to get there? We don't know at this point, but it sure is improving. So our technicals are positive. One thing that did happen is that the S&P 500 was able to break above and then close above the 100 simple moving average. I addressed that in the video for Monday and also in the weekly video that I do. but that was kind of a big deal right now. A lot of times the 100 simple moving average isn't focused on all that much. When we're in a pretty trending environment, we generally go from the 50 all the way up to the 200. Now, when we get more in a range, or if we are in a sideways pattern, then that's when I start looking at the 100-day moving averages more closely. Well, because we've been in that range, I've been watching it pretty closely. And so that's a positive development, the fact that we were able to close above that level. But prices still are in a range until we get back to either the all-time high or to that double top, that previous double top that I keep talking about. We're going to be in that range. And we don't know how long that's going to take. We don't even know if we're really going to get to that level, but things are looking probable right now. Of course, you have the whole Russia-Ukraine situation. And I understand that the president made some comments over the weekend that are causing some uncertainty and some confusion, where the US might be looking to escalate things possibly on one hand, but on the other hand, they came out later and said, no, that's not necessarily what we're talking about here. So there's a little bit of confusion going back and forth. Of course, the markets are concerned with inflation, and I have some charts that I'll go through and show you that, as well as interest rates. I don't have the latest reading on the Fed Watch tool. We're so far away now from that meeting, and it really doesn't need the time to discuss at this point. I look at it every day, and it's about the same as it was. As we get closer to that meeting, I will start to include that again. And then, of course, the lockdowns in China, and those are continuing. And what's that going to do to the Chinese economy? Americans buy a lot of things from China. What's that going to do to the supply chain? What's that going to do to everything, pretty much? And then, of course, the thing that people are really fixated on is the inverting of the yield curve. And it depends on what yield curve you look at. And I have a number of different charts to talk about that. The economic reports that came out were not all that influential. They're helpful and they're part of the overall big picture, but they're not real market movers, the ones that came out on Monday. Again, with the current valuation, and I do have a screenshot of that I'll show you, where if you take the S&P by itself, we are still overvalued. But if you compare it with margin debt and interest rates, we're more fairly valued right now. As far as our trend, it's positive and weakening, but we're seeing what I have been pointing out, what could be happening with the ADX, and I'll go through that. Because we had an up day, the bias was positive, and I'm going to cough. I'm still dealing with this congestion. And then for the last number of days, we have been positive overall. So our momentum is positive. So let's go back, look at what happened on Monday. First, looking at sentiment, we're getting right up to neutral as far as the fear and greed index. And here's the longer term chart. We came up out of that base. That's when everybody was, oh no, the end of the world's coming. Well, prices were able to bounce up out of that. And that's one of the reasons why I think we're advancing right now. Oh, and if you hear a cat in the background, he's trying to say hello to everybody. It's a lot of people don't believe this rally that we've seen from those lows. There's so many negative things out there that people are real suspicious of this whole thing. And that's part of the reason why we're going higher, is if everybody just knows the market's going higher, okay, that party might last for a while, but eventually it gets over. When we were going down, when we were hitting this extreme fear area, everybody was just sure the bottom was going to fall out of the stock market. Well, that didn't happen. When you have everybody thinking one thing or the other, that's when we tend to see the opposite happen. A lot of people are very suspicious of what we've been experiencing over the last few weeks with this bounce, this recovery, and they don't really trust it. And so that's part of the reason why it continues to go higher, because you get this idea, especially those people that like to buy on the dips, or if you're going short, you like to sell on the climbs, if you will. it's like, it can't go any lower, it can't go any lower, and then it goes lower. It can't go any higher, it can't go any higher, and then it goes higher. That's how the market works. And that's why we have to overcome our emotions as much as possible and look at the charts. Because taking an intuition, taking a gut feeling, taking advice from somebody that may be right or may be wrong, that's why in my program, I really try to help people develop this skill for themselves, so that if you have success, then okay, you develop the skill to be able to implement that and experience success, and you get to enjoy the benefits of that. At the same time, if you make a decision and you're wrong, that means you have to take responsibility for it and just say, okay, I was wrong about this. And a lot of people in the financial markets don't really want to do that. They want to be able to blame somebody else. And so that's why there's so many videos, so many programs, so many books out there telling folks how to do this, so that not only can they be helpful to learn from, but then if something doesn't go quite right, we can say, well, I listened to that guy and I lost him on a lot of money because of that. Now you have somebody that you can blame, so you can remove yourself from what really happened. Where the real successful investors, they take responsibility, both for the good and for the bad. All right. So looking at the VIX, we are falling as far as fear, and we have dropped below 20. That's kind of, for a long time, I use static levels. I use 12 for the downside and 20 for the upside. Well, because things have changed and we've become a lot more volatile, especially lately, yeah, I still look at the static levels, but I also plot moving averages on here as well. And so we've been declining on a closing basis, and we've been declining on the daily bar chart as well. But we're now down below 20, which is getting us more into not extreme fear, not extreme complacency. Kind of that 12 to 20 range is where that happens. Then the VIX of the VIX, it actually spiked up a little bit, but on a closing basis, because see, the market started off pretty rough. It looks like we were heading lower, but then we found some buyers coming in. So the VIX of the VIX initially spiked up, but then as the day went on, we ended up closing right at the low. And on a closing basis, we're kind of going sideways right now. And then our Ulcer index, because we're going up, it is declining and not really telling us much. It just means there's not a lot of fear right now, according to this indicator. Then looking at the valuation, and some of these did update over the weekend, where the yield curve, where we had been really extreme, that's this yellow area up here. And I kind of like this. I think this is pretty cool how they give you a little bit of an explanation and then they put the live chart behind it. I think that's pretty neat. And then if you want more information, you can click on a link. But the yield curve, and the one that they look at, I believe, is the 10 to the, is it to the 2? Because there's others that look, there's different yield curves that you can look at. But according to this, we are fairly valued right now. The Buffett indicator, after giving a really extreme high reading, has then dropped off. PE ratio, the same thing, not as extreme as it was before. Interest rates are they're starting to go up, but are still considered fairly valued. Margin debt has really been declining, but as we had a little bit of an upward move, well, I guess that's not an uptick. Okay, and this chart is about a month old now. And then the mean reversion, we've been getting quite far away from the standard price of the S&P over time, and it's been slowly starting to come back, but it's still overvalued. Looking at the sectors, we had 8 out of the 11 sectors positive, and discretionary actually led the way. Woohoo! It's out of last place, at least after Monday. But a lot of these areas that have been getting beaten down, they saw some more strength on Monday, with the financials, materials, and then energy, oil pulled back on Monday, and that helped give some stimulus, at least right now, to stocks. And that was the weakest sector, but energy is still performing the best overall. discretionary is now in the second to last place, where communications has now dropped back into the worst performing sector currently. And then looking just at the tech sector chart here, where we're trying to recover. We were able to get back above the moving average. The moving average is still going higher. So even though we've seen some weakness since the beginning of the year, things do look to be improving. Now, it may just go in the toilet from here on out, but we just have to go with what we see right now. As far as inflation, the CRB declined 2.6%. So it fell back a little bit, and that helped give a little bit of stimulus to stocks. Aluminum, it was up about 0.5% on Monday. And gas actually dropped almost 7%. Still very, very high, but at least in the futures market, it dropped off. Heating oil fell almost 8% on Monday. And then wheat, it was down 3.75% on Monday. So we saw a little bit lessening of the inflation pressures that have been coming through to the market. And then I have a new chart. I figured a lot of things that we do is based on corn. So I have the continuous corn futures contract here. And it actually declined about 0.75%, but you can see how it's been spiking up, especially since the first part of the year. Technical alerts, not very many. The NASDAQ was able to get above 14.2, then 14.3. The materials had a bearish moving average crossover. Healthcare, which is on a weekly basis, has really just been getting hammered. Well, on the daily chart, it has a BPI that crossed above 70. It's not an official overbought signal till it goes above 80 and then drops back down. And then oil was able to get below 110 on Monday. Looking intraday, we had kind of a flat open here, a little bit positive. The futures were somewhat positive before the open. And we saw some initial buying. We kind of danced right along the unchanged level. That's this dotted line. And then we saw some selling coming in. And it's like, oh boy, here we go. And it didn't look too bad. It looked like it could be a normal pullback because we have seen a pretty strong market over the last couple of weeks. And so there might have been some profit taking, and there was some negative news that was flowing through the market, negative sentiment. Well, then some positive news came in that I think one of the things I read was that Russia may be willing to let Ukraine join the EU if they don't join NATO. And that the markets took that as more positive news. And that's when the buying started. We kind of went up to the unchanged, which was acting as resistance, broke through that, got up to R1, and then we're able to get all the way up to R2 and close at the high for the day. So it was pretty positive. Also on the daily chart, here's this resistance level. We've been able to break through that, but there's still overhead resistance right around the 4,600 level with the S&P, and we've got that double top. So there's a lot. We've cleared this resistance, but this is pretty heavy duty resistance here too. So it could be much more positive if over the next days and possibly even weeks, if we could eventually break through this resistance level, if you're bullish on the market. This could also be a point where we may see a bit of a pullback if we hit this level and people decide to sell. Then we're down 4.61% now from the all-time high. Growth saw a little bit of an advance and value saw a decline. Then looking at the different indexes where growth had been in a pretty strong downtrend, well, now it's trying to recover and it's above the 50-period moving average, but still has quite a ways to go to get to the 200. Then looking just the inverse of that, where value had been seeing some strength, pulling back and has dropped below the 50-period moving average. NASDAQ 100 against the S&P actually outperformed. Some tech areas had a pretty good day on Monday. And then this is one of the newer charts. This is just an index of the value stocks. Well, they actually declined almost 0.2% on Monday. Where we look at the next chart, these are growth. This is a growth index where we're still kind of going sideways overall, but we were up over 1% on Monday. So that's where we saw some real strength with growth stocks. As far as our trend, the ADX, this is what's kind of interesting. You see how the green line is crossed above the red. That's positive. And the green line is starting to move away. And you see how the ADX is ever so slightly turning. If we see some follow through buying and this green line keeps going up and the red line goes down, we may be able to cross over and be in a trending environment with an uptrend happening. Now, we might hit some of this overhead resistance and then just bounce right down. But this is just one thing to keep in mind as we're going through this. Our Arun is also looking quite positive. It's pegged near the top as far as buyers. Sellers are decreasing, and the oscillator between the two showed an advance. We're still coming off of that Pring bottom fisher signal that was generated. Decision point charts have not really changed. Up on a short term, looking positive, more indecisive intermediate term, and positive longer term. As far as our breadth, seeing an improvement based on price and above the moving average, seeing an improvement based on volume, but still below the moving average. The advanced decline ratio also showing some improvement and not necessarily extreme at this point. New highs, new lows. They trailed off on Monday, but still continue to be in an overall uptrend. Accumulation distribution showing some strength and seeing the moving average turning up as well. Short term, we're well above our 20-period moving averages right now. Short-term moving average study, we're starting to get a little bit extreme on the 20. We're improving in the 50, and looks like we were flat pretty much on the 200. Then our moving average spaghetti tree just shows we've been able to get above and close above the 100-period moving average. So as of right now, all the moving averages that are plotted here are below current prices. So if we start to fall, some of these levels might end up being support levels. MACD, positive and climbing. STO finally got some love and started to turn up based on price and volume. The McClellan oscillator showing us kind of an extreme reading, but a positive reading nonetheless. Stoke RSI, pegged near the top. Williams percent R, pegged at the top. Force index, not giving us an extreme reading, but still looking rather positive right now. Intermediate term, well above the 50-period moving average. And here's the 100-day moving average. That's, if you're bullish on the market, seeing that is pretty positive. So that was kind of a critical thing. There are some other moving averages, especially in the Dow, that we really need to keep an eye on. And I'll talk about those a little bit later. The PMO overall is going up, as well as based on price and volume. The PMO study, those that are rising, starting to look a little extreme and rolling over just a little bit. Those that are giving buy signals also still going higher, but getting into an extreme positive reading and showing improvement as far as those that are even above zero, just even giving a positive reading. This is kind of interesting. And you can take this half full, half empty. The BPI with the advance on Monday didn't really advance, okay? You could see that half empty by saying we advanced, but there was not a lot of point and figure signals, new signals that were generated, okay? And you would be right to say that, because on an up day in an uptrend like we've been seeing, you would want to see the BPI show more strength. Now, on the other hand, you can take this as half full by saying, okay, the stocks that have been performing well are continuing to perform well, but are not necessarily setting new highs. So we're seeing more internal strength. So you can take that either way, half full, half empty. Then here's just a longer term view of the BPI, a moving average rainbow. We're coming up out of all of the moving averages right now, but we're going to need to see this go higher for all of these lines to turn back up. Stochastic, also short term, quite overbought. intermediate term, overbought. Longer term, rising and getting to an overbought level. Again, so if we see a bit of a pullback, maybe even a few days of a pullback, as long as it doesn't get out of hand, it may not ruin the integrity of this uptrend, but wear off some of these overbought readings. Then looking back in the rate of change, 10 days, we're giving right now a pretty extreme reading. And if you look back, if you count back 10 days, we're down here. So it's not really surprising that this is giving us a pretty extreme reading right now. The summation index, this is also positive because not only are we advancing based on price, but we have crossed above zero, where based on volume, we've been above zero for quite some time now, and it's also advancing. All of our momentum oscillators continue to be positive. And I had an interesting question that, do I ignore the oscillators on the weekly charts? Yeah, I do. Now, if you disagree with that, let's talk about it, because to me, it's more of a way that they're calculated, and the weekly charts are a lot longer. And as lower prices fall off the calculation, now you have higher prices as part of the calculation. And so the oscillator, it has to roll over, even if things are still looking positive. And that's why on longer term charts, weekly, monthly, I don't pay as attention to the oscillators. I do find them quite useful for the daily charts, because that's a smaller time frame, and I think it reflects more of what's actually happening, and they can react quicker to price changes. That's just where I come out. Now, if you vary, if you have something different that you've concluded on that, let's talk about it. I'd like to hear different perspectives on there. The vortex also looking more positive. Green line up, red line down. RSI also showing that it's advancing without giving us an extreme reading. The CCI 14 periods coming off of an extreme reading, and 20 periods is still extreme and rising. Standard deviation, as we're slowing down a little bit, we are seeing prices coming back more to their standard price, at least based on this chart. Chaikin oscillator also giving us an extreme positive reading. Chaikin money flow improving and advanced slightly on Monday. The ultimate oscillator also giving us an extreme positive reading. We were able to break through the itchy cloud, and so now we are above resistance, which now could potentially act as support. As far as our trading systems, here's the Elder. We have green bars for the S&P, and I have some additional Elder charts that I'll show later on that go through the main ETFs that we look at. In fact, here's one of them. This is the Elder system plotted with the SPY, the spiders, the ETF for the S&P 500, and it is positive also, with the MACD also advancing. The SAR, the dots are underneath, so the trend continues to be positive. Our different charts, our Heiken Ashi continues to show a lot of white candles and much improvement. KEGI also advanced slightly. Renko also redrew and is looking more positive. 3-line break also looking fairly positive right now. Equivolume showing a lot of open green candles more than we're seeing red, so that is also positive. The one thing to keep an eye on is the ease of movement indicator down here, where we're starting to get a little bit extreme. Point and figure, this, if you wanted a bullish market, this is one thing that will help that scenario, in that we had a new green extron. It's still coming off of a double top breakout, where we had the two tops right here, and with the advance on Monday, we were able to draw in a new green X. Stochastic, my gosh, Fibonacci, these crazy words that we have to deal with here. We have gotten above the 38.2% retracement level right now. So we're kind of in clear skies, at least at the moment, as far as the retracements based on this chart. Long term, we are still above the 200-day moving average. And as long as we stay above that, the long-term trend will continue to improve. And here's the logarithmic chart as well. Then our big mega stocks, they are showing some improvement. They were up 1.63%, and they've been able to capture the 50-period moving average. Can they get back to the 200-period moving average? Special K is starting to turn up and is seeing this latest action and likes that. And then here's just a longer term view of that chart. Moving average study based on 50-period moving averages. We're advancing. And on this chart, not necessarily giving us an extreme reading, also showing improvement on the 150-day and the 200-day moving averages. Broad market, here are the three indexes that we look at where we see the S&P really breaking out. The mid caps, they're trying to break out, but they're kind of slowing down to more sideways, where the small caps really haven't broken out all that much. Then this is another new chart. This is the Dow Jones Composite Average. If any of you are familiar with Dow theory, where you have the Dow Jones Industrial Average, that's one index, and then you have the transports, and both of them should be making highs at about the same time. They need to confirm each other. Well, some people also include utilities in that mix. Well, what this chart does is it takes the Dow, it takes the trannies, and it takes utilities and puts them together in an index. How is this whole group performing overall? Well, after being in a bit of a downtrend for most of 2022 and actually having the 50-day moving average act as resistance, we've been able to break back above that. And these are shorter term moving averages. This is a 13-period moving average, but we're showing what could be a breakout, and we're also getting above what had been previous resistance. So this just gives you more of a broader spectrum of how are things going according to the Dow transports, and the Dow utilities. Then the FANG stocks had a good day, up over 2%, and look like they're putting in some healthy bars on this chart. Kathy had a pretty good day. She's coming back up to the moving average. It was up 3.95 for the ARC fund. Then this is a critical thing, and I actually put this at the end of the video as part of the notes. The Dow is right below its 200-day moving average. Its 200-day simple moving average. That is a big deal. The S&P, we've been able to break above that. But what most people pay attention to, what most people use as their gauge for the stock market, and what the financial media love to tout, is the 200-day moving average on the Dow. Of course, there's the debate that goes back and forth. Is an exponential moving average better? Is it simple moving average? And I deal with that in my classes. But right now, if the Dow can have an up day and actually close above the 200-day moving average, that would be quite positive. And for a lot of investors, that might be what they're waiting to see will happen. Then here's another new chart. This is the diamonds. This is the ETF based on the Dow, and where it's more neutral right now. It hasn't been bouncing up as much. It had some really good days that were green, but lately we've been more in a sideways pattern. Then looking at small caps, where they were actually down on the day. And after that nice little breakout that seemed to help the S&P go higher, well, they're not really showing a lot of follow-through strength right now. And then the mid caps, they're also bumping up into the 200-day moving average. Probably not as big of a deal as if the Dow was able to get above it. But if we have an up day, whether it's Tuesday, Wednesday, or sometime, if both of these can close above the 200-day moving average, that would be quite positive and would add more to the bullish case. And looking at the NASDAQ composite, it still has a long ways to go before it gets to its 200-day moving average, but it was up 1.33% on Monday. NASDAQ 100 up over 1.5% and showing some strength, getting a bit close to the 200-day moving average, but it's still a ways away. The VIXN declined as prices in the NASDAQ 100 actually advanced. And I pointed this out in a previous video. It was a little bit of a concern where we were going sideways with the Vixen as prices were going higher. Well, we saw the Vixen really drop and close near its low. Remember, that's the fear gauge for the NASDAQ 100. Then here's another elder chart. This is the QQQs, which is the ETF on the NASDAQ 100. And that is positive now. We've been able to break above the moving average. The MACD is positive and climbing, and we have a green bar for the Qs right now. Then the NYSE, this is still positive. It really wasn't up all that much, but it's above its 200-day moving average. Can it stay above that moving average? And then looking at the S&P 100 against the rest of the S&P, we're seeing the bigger stocks, they outperformed slightly on Monday. And here's another one, the Wilshire. This is broad-based measurement. It's butting up right against its 200-day moving average as well. So if we can see that and the Dow and the mid caps, if we get an up day, that would really help probably the sentiment, because there's a lot of people, this is their system. When these lines cross, you get out or go short. When these lines cross positive, you go long. And that's a whole system that I teach as part of my class that's available on my YouTube channel. It's called the SMAC strategy. I think that's what I called it. Anyway, internationally, we're seeing some improvement quite a bit here. And with our all stocks, we're up 0.39%. Please excuse my voice. And I'm not able to stop the recording right now. I will take a drink though. I tried to initiate the pause button and I ended up screwing up the whole video. So you're just going to have to get me with the coughs and hacks until I get my other software up and running again. Then this is the world index looking at non-US stocks where they were actually down a little bit and they're still having some trouble. So if you look back over here, we're seeing some improvements. Over here, non-US stocks, and not so much improvement. That just tells us that the US leads the way. If the US market ends up really going up, the rest of the world will follow, and vice versa. As far as other broad markets, the dollar was up again. My goodness, it's up over 99 right now. And then here's the early version of the weekly chart for the dollar. Here is oil, where it closed down at 105.96 on the futures here. And then gold also was down 0.75%. It's looking again like that breakout is failing, at least right now. And here's the ETF. It was down 1.82%. And here's a longer term view of the chart as well. Silver was also down 2.34%. It really got hit. High silver. It's going the wrong way. Here's a longer term chart of the ETF. And Bitcoin is looking like it might be trying to break out. It had been in the low 40s, then mid 40s. Well, now we're getting more towards the upper 40s. As far as bonds. And this is where I have some new charts and where I might expand a little bit. This is the yield curve between the 10 and the 2. And that's what most people look at. And you're hearing about the inverted yield curve, and it's already inverted and blah, blah, blah. No, it hasn't. Not the 10 and the 2. There are other yield curves that have inverted. Take your pick. It's like a buffet. So what we do is we're just going to look at all of these every day and then see how things go. And even if any of these yield curves invert, it could be 12 to 24 months before a recession hits. And just because we go inverted does not always mean that a recession will happen. Now, we use other areas to do that, but it's not that cut and dry. It's not that black and white. So that's why we have to take a deeper look into this to try to come up with, okay, what's happening in different areas and then putting that together and then saying, okay, this is what we think is happening here. Then another one, this is the spread between the 30-year yield and the 5-year yield. And it's getting really close to going inverted right now, where the 5-year rate just might be higher than the 30-year rate. And that could portend to some economic problems. Back in 2008, you see an inverted part here? No. Back in 2006, it went inverted, but things got better after that. Back in 2000, this is when we did have some problems. This is the dot-com boom and bust, and then we ended up in a recession after that, and then 9/11 happened and so forth. So we'll look at this and then just see what it's telling us. And then this is also looking at the 30 to the 5-year. Didn't I just look at that? Okay, I'm getting some of my charts confused here. That's the same chart. Okay, so I put it up here twice. Wasn't that nice? Double the pleasure. Okay, then looking at the 30-year yield, where we're breaking above the 50% retracement as far as the Fibonacci level is concerned, we're really breaking out with the 10-year. We're well above the 61.8 retracement and going higher. And then treasury yields over here, where we're seeing the longer maturities, they're starting to decline, but the shorter maturities continue to advance. And that's part of this whole debate that's going on. We're seeing short-term rates go up and longer-term rates either stay the same or coming down. And that's what's causing this inverted yield curve. When we have what's called a steep yield curve, that usually means that the economy is doing quite well. When we have an inverted yield curve or a flattened yield curve, that's usually when there's signs of economic problems. Then internationally, this just shows you what the yields are currently. And then this is the index based on bond prices, where it's just, man, we're getting down to some other levels. But the question is, can we even drop below that? If interest rates keep going up, yes, we will drop down. Then the corporate bonds actually showed a bit of an improvement on Monday, and the yield, again, this is not synced up. This is as of the 25th. So this information is a few days old, but it just shows that corporate yields are also rising right now. Junk bonds were up 0.5% on Monday, and they tend to go more hand in hand with the stock market. Looking at the relative studies, we're seeing a breakdown in the gold to the SPX. It looked like it was breaking out, but now it's coming down. Energy against the S&P, that's still holding up quite well. Even though it declined on Monday, this ratio between the two, it's still in a pretty hefty uptrend. And then looking at growth against bonds, that's showing a lot of improvement right now. And of course, with bond prices going lower and lower, anybody could outperform what bond prices are doing right now. So anytime we have an up day in the markets led by growth stocks, they're right now anyway going to outperform bond prices. And then this is tech sector against the S&P. It's still negative, but showing some improvement. Can we get above this moving average here? And then here we have tech against interest rates, where this is just showing as tech is declining overall, even though it was up on Monday. We had a little tick up right there. Overall, as interest rates go up, that really affects tech companies because they have to borrow a lot of money. And if they have to pay more interest to expand or to do research and development, yeah, it's going to eat into their profits. Then looking at the inverse of this, here's the 10-year yield going up against tech. Even though it declined, it is still in an overall uptrend. And then looking at discretionary, which had a really screaming day on Monday, it really outpaced staples and is showing some overall improvement, but is still in a downtrend. We broke above this moving average. Can we even dream of getting back to this moving average? And then looking at the S&P against the 10-year yield, again, this bounced up a little bit, but you're seeing interest rates declining, at least on Monday, and the S&P going up. So that's why you're seeing a little bit of an improvement. But overall, as interest rates continue to go up in a comparative basis, the S&P is in a downtrend when compared to the 10-year yield. And then this is the low volatility stocks. These are the ones that people like to get into when they're not as happy about things, or when the market might be taking a turn for the worse. They might do less bad than some of the other stocks. They were up 0.44%. And then here is just a gauge to show how have these low volatility stocks performed against the S&P. Well, it looks like we're breaking out. We're still positive, but it could be coming back down closer to this moving average. So what's our outlook? Again, this copy and paste here. I do have a couple of new things though. We're still out of correction territory. We're still in an intermediate term range. We're getting closer to that short-term double top, and I might even have to switch that to an IT double top for intermediate. We're getting close to the end of earnings season. We're still battling between growth and value. There are a lot of yield curve concerns. And then I actually put on here as of Monday's close, the 200-day simple moving average on the Dow is at 34,979.33. Now, once Tuesday opens, that's going to recalculate slightly. So, but right around that level, if you watch the market, if you keep an eye on things, watch for this to see, especially as we get closer to the close, and just see, are we able, now if we're having a down day, no, not much left to watch there. But if we're going up and it looks like we can close above that 200-day moving average, that would be quite positive. Economic reports, we have consumer confidence. That's kind of the big one for Tuesday. We have the JOLTS report coming out. We have the FHFA housing price index. And then this is usually a precursor to the employment report coming out on Friday, which is the S&P Case-Shiller home price index. It comes out, and then there'll be the ADP report that I think is coming out later in the week. And this is Robert Shiller, and I'm a big fan of his, and I read his books, and he's come up with some interesting indicators that we can use. We're still battling with Russia, Ukraine, and what's happening there, and then China with their lockdowns. And then how are people interpreting what the president said? Is it scaring people? Is it giving the US a sign of strength? Is it showing weakness? Is it emboldening Putin and Russia? I mean, the debates are going back and forth. And again, we don't really care about, we just want to know what's happening. Now, on a personal note, you probably have a strong opinion about this. That's okay. But try not to let that bleed over into your decisions in the stock market. We have to just take things for what they are right now. Then our scenarios. If we're looking to go down from here, here are some possible things to look for, and I've actually added one. Are we going to revert back to the previous trend before the Fed met? Are we just getting higher right now to wear off the extreme negative readings before we're getting set to go lower? With each passing day, this is looking less and less likely. Unlikely, and our technical picture is improving drastically, so that A just does not seem very probable right now. B is quite probable. We're showing some short-term overbought signals. We don't have any resistance as far as moving averages, but we do have previous price levels. And well, we do have a moving average in the Dow and in the mid caps, and then the other one that was it the Wilshire, whatever it was. And then we also are seeing the stock market focus more on rising interest rates. That happened last week, where interest rates were really going up, and that was pushing stock prices down. So we want to be able to keep an eye on that. If interest rates really go up, we might see some weakness in the stock market. Now, what's our scenario for going up from here? We are coming up out of that base. Our oscillators are positive. The moving averages are pretty much, we're providing support at this point. There is some resistance that we would have in other indexes that I've pointed out now, and we were able to exceed the previous high. So that's good. And then the general disbelief. Man, why are we going up? This doesn't make any sense. It can't go any higher. This is just a bounce, a dead cat bounce. We're going to get set to go lower here pretty soon. And then the market goes up. And that's what happens a lot in the markets. That's why I really like technical analysis, where we look at what's happening on the chart, because it may go totally against with what our logic would come, what conclusion we would reach that way. All right. Then we have our sideways, which is possible, but it's still a few days away at the earliest, with the ADX dropping below 20. That's if we see price movement really slow down and we get more into a trendless environment. That doesn't really seem likely. So what I'm seeing right now is, yeah, we're positive and we could still go up from here. That's kind of the overall scenario. But because of B and C, we also have to look at a potential pullback at the same time. And if we do pull back, we want to watch that closely to make sure, what's volume doing? How strong is it? How convicted does the market seem to be with things falling? And that's why I watch this stuff all the time, to get a feel for those things. Okay, so our conclusion is that overall the S&P is positive. Short term, we're positive. We're at some overbought levels. We still have overhead price resistance. Intermediate term, we are positive. Our oscillators are positive, and moving averages are providing support and resistance. Long term, we are above the 200-day simple moving average. So that means that the long-term trend is improving. Then another thing I want to point out is, if you want to look at some things that I'm hearing about, and I was running across some articles, I'm not going to really address that, other than I just did a Google search and then took a screenshot of it. There's this idea to propose a 20% tax. Now, it's supposed to be aimed at billionaires. Well, what do billionaires do if they have to pay a lot of taxes? They move to other countries because they can just do that. The thing that concerns me from a stock market perspective is, there's even talk of taxing unrealized gains in the stock market, where you might have been buying stock for 40, 50 years in an IRA or some kind of a portfolio that you have. The nice thing about that is, as it grows, now you have to pay tax on the dividends that you get, because that's income. Or if you sell part of it, then you have capital gains. The nice thing is, as long as you don't sell it, you don't have to pay any taxes on that. Well, now they're coming up with an idea saying, okay, let's say you bought a stock at 10 and it's now at 50. We're going to tax you on that other 40 points. Even though you haven't sold your stock, you're still going to be taxed on that. What in the world is that going to do to the market? People are going to say, oh, I don't have the money to pay that kind of a tax. I'm going to have to sell the stock. And that could really do some long-term damage on the stock market. Now, every once in a while, these things are proposed, and sometimes they get shot down. I believe they tried this in France a few years ago, and it just didn't work at all. All the rich people moved out of France, and they eventually just said, okay. So this is one of those things that might sound like, yeah, we're going to hit those billionaires. We're going to really get to them. Well, that's where the income tax started too. It was just to get the wealthy people. And then it kept dropping. Then it got down to the millionaires, then the thousandaires, then the $100 heirs. I mean, it got to the point where then everybody is having to pay this. I'm not saying that's what will happen here, but there's talk about that. And to make it more appealing to people, they're going to try to sell this, if they go forward on this, as a tax for the ultra wealthy. But it doesn't usually stay at that point. Now, this might be the one time in history when it actually does, but we have a lot of precedents in the past where something was sold to the American public as just being for some elite folks, only to have that come drifting down to everybody. So, and here are some articles that you can go. One from Bloomberg, Fox, Forbes. These are all three pretty respected financial media outlets. Another thing that I ran across is a thing on the yield curve. And I'm just so afraid of this video going so long. I'm going to go ahead and go to the very end here, and I'm going to do a separate video on just the yield curve. And I hope I have enough time to be able to do that. So check out some of those other articles. Again, it's not to get a debate going back and forth. I don't care what somebody's opinion is. On a personal level, yes, I do. And we can talk about that. What we're focused on here is, how does this affect the stock market? And that's a really hard tool to learn, is how to check your opinions at the door and then look at things for what they are. Are they going to help the market go up, or are they going to help the market go down? Then once you decide that, now you can go off and say, oh, this is the greatest idea in the world, or this is a terrible idea, and I think you're silly, and I think you're smart, and all that stuff can happen. But you'll have a hard time finding success, consistent success in the markets, if you bring your opinions into your investing, into making your decisions as far as buying and selling. And because the market doesn't care what your opinion is, it's going to do whatever it's going to do. So anyway, that's what experience has taught me, and what I've seen not only in my own career as an investor, but through a lot of other people as well. So thank you. Have a wonderful day. I'm going to try to record this video on the yield curve, and I will prepare the next daily video after Tuesday's session.